So, Alicia, this is the setup, right? The market for a while seems like it's been betting on a Fed rate cut or cuts and hoping that it's not because the economy needs it. So is the market correct?
So, you know, at first blush, it looks like Powell has a dilemma because the jobs report was much better than any of us were expecting. All of us were away. We're a little surprised. Markets were a little bit quiet on Friday. You would have thought they would have sold off more. But as Steve pointed out, the signaling has been all about inflation not meeting target, heightened risks from overseas slowing growth, and trade uncertainty, which still has the opportunity to hit the real economy here in the U.S. And we see the G20 as simply being neutral, slightly positive in that tariffs were not put on, but the trade war is alive and well, and that uncertainty is alive and well while current tariffs remain. So 25 is on the table, and the Fed doesn't cut once. So if they go at 25 in July, we should expect another 25 for the rest of the year. And
has the market already kind of taken account of that? Does that explain where we are? Is that going to be reason enough for the market to keep getting going higher?
So the market has priced in all the great news. And what it hasn't priced in is earnings rolling over. So we had a stabilization of the earnings decline sort of in the April and early May timeframe. And once again, we see earnings coming down for 2019 and 2020. And the market's still pricing in 4 cuts, 100 basis points by the end of 2020. So the good news is already in. And it just seems that your risk is to the downside. However, we have a sea of liquidity coming from every central bank globally, and that will sustain markets for a while.
If I could just pick up on what Alicia's saying and throw a question to Peter, I don't know if there are any hawks left on the Federal Reserve Board.
One.
Well, hold on a second. There are more dovish and lesser dovish, but there isn't a hawk. Even Mester, who used to be one of the hawks, says, I don't think we should cut. She's not saying we should raise. There's nobody in the face of a 220,000 job number. GDP running on average over the last several quarters above trend. Unemployment is low. Nobody's saying we should be hiking into this. So I don't know. Am I missing something, Peter, in terms of who's your one?
No, Esther George is the only one.
Barely? What has she
exactly.
said that makes you think she's a hawk?
No, barely. So she was probably the one dot that had a hike at the last meeting. But putting that aside, she's not voting, so it doesn't matter anyway.
Right.
But you're right. They're inclined to ease, but that's the asymmetric.
And now you got a couple guys, a couple folks coming on, and Judy Shelton and others, who I think they want to. I don't know what they would do, but they want to cut a lot.
And look what's going to happen with the ECB. We have Christine Lagarde, which was, I think, was a shock to a lot of people when we heard that she was in the lead for the ECB, the head of the ECB. She will continue Draghi's policy, and perhaps more so because she's a political figure. So her job is to keep the union together in a political way. So there's global liquidity here, and asset prices will move higher. The real risk here is that you get into the bubble situation that you had in 1998. So the question is, can lower rates and lower yields actually produce growth in the real economy and a higher multiple?
Peter's the only hawk.
But the thing is,
he's the only one who writes about consistently the potential excesses from having rates too low for too long.
Well, that, and also look at the experience of the ECB and the Bank of Japan. The Japanese bank stock index is down 90% over the past 30 years with all this easing. So I'm of the opinion that what you're doing to bank profitability is not easing. You're actually doing restrictive policy when you damage the banks, which is the transmission mechanism for your policy.
And Germany's the perfect example of this as well. It's the same thing. You've damaged the banks. You can't grow the economy. You have the lowest yields globally ever, and you can't grow the economy.
And further still, banks are a more important transmission mechanism in Europe than they are here because of the underdeveloped bond market.
This all could be true, though, but then you still have a situation where the Fed, in the rates under its control, has 3-month Treasury yields above 2%, and almost no bonds in the rest of the world are anywhere near 2%.
Right.
So that's an anomaly. I think the Fed also has to keep.
A positive 70 basis points. Be still my beating heart that you are way too restrictive at a positive 70 basis points.
How much dry powder does the Fed need to have in case of a legitimate downturn?
That was the one thing that leaned against the idea of a cut. When it was gathering at first, there were some folks still talking about dry powder. The dry powder argument has kind of been put in storage. The new
Not if it's still front and center within the halls of the Fed.
It's not, though. The new Minglewood thinking is that
preemptive is better.
Preemptive is better. That was the thing. I forget how that all came up. It began actually with a commentary that I broke on your show from Bill Nelson, former high-level Fed staffer, who said this: the thinking out there is that doing more earlier when you're closer to zero is a better way to approach it.
Is that Powell's thinking?
And Powell echoed that in the press conference, the last press conference he did.
To what extent is what the ECB is doing and saying, and Bank of Japan, also relevant there, which is that the longer we stay higher when they're continuing to ease, the more it's going to hurt us before we've acted?
I think that's right. I will point out that President Trump is not right about the dollar. He has complained about having a dollar that's appreciated. It is not. President Obama's economy is the one that suffered the big appreciation of the dollar, which happened around 2014 when the market correctly sussed out that there was going to be this massive differential. And on average, I did the work just a couple weeks ago, the dollar has been slightly weaker under Trump than it was under President Obama. So that's not been accurate.
Alicia, just to bring it down to how to react to all this right now. If the market has already priced in the great stuff, where does that leave you?
So, look, I think you do have asset price inflation here. I think you can't escape the sea of liquidity. And with $13 trillion of negative yielding debt globally, our yields are going to stay low, and that's going to pile people into equities. So markets moving higher. But ultimately, the fundamentals have to follow. I don't think anybody would be surprised if we had a negative earnings growth this year. That seems to be baked in. So I think we're okay for the next few months.
Can I follow up on that? Because I think that's an important point. It is better to have stronger growth and stronger job growth than it is to have Fed cuts. The history of this thing is that the Fed can cut, and it will not completely offset, especially in earnings, weakness. That you have one or the other, you would take higher growth and higher rates than the other way around.
For sure. Absolutely. I mean, it's a little bit of financial engineering that's going on here. But if you're asking about the market specifically, we're moving higher.
Yeah, which is why the market implicitly needs us to be just a flattening out of earnings, not a cliff.
Right.